valuation of a five-star hotel using discounted cash flow method. This is the topic that we have for today's session. And in this session today, we are going to understand the discounted cash flow method or valuation of a five-star hotel using the discounted cash flow method with the help of a case study. So, how discounted cash flow method can be applied in case of a five-star hotel? That is what is going to be our focus in this session today. Let's begin with valuation conundrum. So, what is value? Very simple definition of value is nothing but utility. Value is nothing but utility. An asset that has a utility will have a value. An asset that does not have a utility obviously will not have any value. So value is synonymous of utility. Value is synonymous of utility. What is valuation? Valuation is quantifying utility of an asset in terms of money is valuation. And why do we do valuation? We do valuation because we have to take a decision. Remember, whenever all of us will be asked by a client to do valuation of an asset, it would only be when the client has a decision to take. So why do we do valuation? We do valuation because somebody has to take a decision. What we find through valuation, and very simple, through the process of valuation that we all carry out, what we try to find out is nothing but fair value of the asset which is in question, and that is what we try and find out. How to do valuation? So valuation करेंगे कैसे? That is what we will understand now. But before that, what is premise of valuation? So basically, there are two premises of valuation. Of course, one can name many more, but primarily there are two premises of valuation, and one is the premise of liquidation, which means when it is expected that the company or the property that is to be valued, that company is going in for liquidation. So that is one premise, and the second premise of valuation is the ongoing concern, which means the company that we are trying to value has a life, and therefore the valuation is going to be based on the premise it is a going concern. Now, how do we use discounted cash flow for valuation? That is what we will understand in this session today. So first question, just to be on the same page for every one of us, how to do valuation? So basically, there are three approaches, as we all know: income approach, market approach, and the asset approach. Under the income approach, there are two methods: income capitalization method and the discounted cash flow method. What is income capitalization method? Income capitalization method would primarily use the past data as to how this company, what kind of return this company has earned in the past. Now, making that as the basis, valuation is done, and that is your income capitalization method. Second, under the income approach is discounted cash flow method, and that is what is our prime focus today. Discounted cash flow method would mean you don't take into account the past earnings. What you take into account is the future earnings. So you try and find out as to what kind of earnings this company is going to generate or is going to give to me in the future. And you try and first find out as to what is the cash flow this company is going to generate for me. Convert that cash flow in terms of the present value, and the total of the entire amount of the present value becomes the value of that company or of that business, and that is your discounted cash flow. It is referred as discounted cash flow primarily because what we do in this method, we do the discounting of the future cash flow. The second approach is the market approach. Now, why market approach? There are primarily two methods: comparable company method and the comparable transaction method. So, meaning what? Meaning uh, the company that we try to value. Uh, Remember, as per the valuation hierarchy given under the India's 113, India's 113 gives three levels of hierarchy for the purpose of valuation. And what number one is level 1 input. So the level 1 input, according to India's 113, says that in case if the asset or the company that you're trying to list is that you're trying to value is listed on an exchange. So what you do, you just take the quoted price. So that is as per India's 113, which is on fair value measurement. Level input 1 would mean quoted price. Now remember, it's not that all the companies or all the assets are listed on an stock exchange. So there are many situations where a company or the asset that we are trying to value is not listed on a stock exchange. So what do we do in that case? So in that case, the India's 113 prescribes a label 2 input. And what is label 2 input? Label 2 input simply means if the company or the asset that you are trying to value is not listed on an exchange, and if you have to do the valuation of this asset or this company, what you can do, you can use the comparable method. So comparable method simply would mean this company is not listed, all right, try and find out a company which is similar in nature and type, which is listed on a stock exchange, and then you can use the listed price of the other similar company which is comparable in nature as the basis for the purpose of finding the valuation. So that is comparable company method, when you are simply comparing company to company, and the other one is comparable transaction method, and that would mean you are looking for a specific transaction. Now remember, it is also possible, number one, there is a company, it is not listed, and number two, there is a company, it is not listed, and it does not have any company which is comparable. Now the question is, how do you do the valuation of a company like this? So according to India's 113, you can do the valuation using the label 3 input. And what is level 3 input, or what does the level 3 input would mean? It would simply mean that if there is no information available about the asset or the company that you want to value, that means neither this company is listed on an exchange nor this company has got a comparable company to use as a basis for the purpose of valuation. In that case, the India's 113, which is on fair value measurement, it says that use level 3 input. So what is level 3 input? Level 3 input would mean create your own information, create your own details, create your own data, create your own input, and using that input you can do the valuation. And that is where the discounted cash flow method comes into the picture. So invariably you will use the discounted cash flow method for the purpose of valuation in respect of a company or an asset, number one, which is not listed, and number two, which is also not having any comparable company. So in a case like that, you will be using the discounted cash flow method, and that is the label 3 input. And that is where we were before we came on the India's 113. So the market approach is basically nothing but label 2 input. And then of course you have the third approach, and the third approach is the cost or the asset approach. Under the cost or the asset approach, you got a book value method, which simply means pick up the book value, pick up the value as given in the balance sheet, and that becomes the basis for the valuation. Number two is the adjusted book value method. What would it mean? It would simply mean that you don't pick up the values as given in the balance sheet. You make necessary adjustment into them, or you adjust the figure given in the balance sheet. Meaning what? Meaning you are doing valuation of a company, and that company has a land which this company had purchased 50 years ago at a price of 1 crore of rupees. Today that asset is worth 100 crore of rupees. So now when you're doing the evaluation of this company using the book approach or the asset or the cost approach, don't take the value of this land as 1 crore, adjust it for is the current value, and that is take 100 crore as the value of that asset, that is the land, and that is how it is called as adjusted book value. Number three under the cost approach is the replacement method, and number four, replacement method would mean if the similar kind of asset, similar kind meaning as it stands today, if similar kind of asset is to be replaced, then how much would that cost? That becomes the replacement value. And the fourth under the asset approach or the cost approach is liquidation value. And what does it mean? It simply means here is a company which is going in for liquidation necessarily, and therefore if it is going in for liquidation, if all the assets are to be sold, then how much money would be realized from the sale of those assets, and from the sale of those assets the money that would be realized minus the amount that you will spend in realizing the money, and whatever net becomes remains in your hand, that becomes the value of those assets. So these are just to be on the same page for this session, these are the broad three approaches of valuation, and under those three approaches there are many methods for the purpose of valuation. Friends, here I would like to give you some additional input, and that is, in my view and in my understanding, the discounted cash flow method is the most fundamental, dependable and reliable method for the purpose of valuation. You only have to take two precautions. Precaution number one, when you are doing the projections, when you are building the projected cash flow, make sure that your projected cash flow are as realistic as possible, because if you make a mistake in the cash flow projections, obviously your valuations will be accordingly wrong, or will be higher or lower than from the real value. So the first precaution is make your projections as realistically as possible. Therefore, take the right assumptions. And number two, the cost of capital that you will use for the purpose of discounting, again, be as realistic as possible with regard to determining the cost of capital. Because if you make a mistake either in making the projections or in taking the cost of capital, remember these two factors will completely, if they are taken wrongly, they will completely distort the valuation that you are trying to arrive at. Having said that, if you have done the cash projections which are realistic, and if you have taken the cost of capital which is again realistic, you can be rest assured that the valuation that you are arriving are truly fair value, and they could definitely be used for the purpose of any decision making. And that is what is my view as far as the discounted cash flow method is concerned. Under the market approach, of course, when you are using the quoted price, but in my view, a quoted price also should be cross-checked with the discounted cash flow method. And why do I say this? That is because there are umpteen number of cases, and we all are aware, when a company was quoting at a very high price, and suddenly within couple of weeks or couple of days or couple of months, the price crashed like anything. And therefore, whenever you are doing valuation, even for a listed company, in my view, it is better to cross-check that value by using the discounted cash flow, because then you will have a better confidence in the value that you are arriving. As regards the cost approach, it is good mostly in cases of liquidation, and it gives you basically the downside value. So friends, one more thing that we need to remember, all these approaches or the methods, remember, they do not give us a price. They only give us the reference point from where the price can be negotiated, Now the question is, when and where the discounted cash flow method be used?